Hi, everybody, and welcome to today's FinTech Talk. We are starting a bit differently because we had some technical difficulties with our host not being able to dial in. So I'm going to start. I am Danina, the producer of FinTech Talk. And today we are going to welcome our lovely guests. We have Sean from Amber Data, we have James, and we have Deborah, if you guys want to come onto the screen. Hi, everybody.
Hi. Sean Douglas, co-founder and CEO of Amber Data. We're the leading provider of digital assets data for institutions and really service the entire value chain from front office to mid office to back office.
James, if you want to go next.
James Harris, I'm Chief Commercial Officer at Zodia Custody. Zodia Custody is a leading digital asset custodian, and we're backed by Standard Chartered Bank, SBI Group, and Northern Trust. We're an institutional and regulation-first custodian based in the UK, Europe, Singapore, Hong Kong, and Australia. So happy to be on this, and with so many familiar faces here. So Sean and Deb, really nice to see you.
Thanks, James. I'll jump in introduction. So my name is Deborah Algio. I'm joining from Sydney, Australia, from National Australia Bank, or NAB. I'm the Director of Innovation at NAB, and at the moment specializing in digital assets. And thank you very much for having me.
I think we have Charles now, so I'm going to jump off and actually give way to Charles, and hopefully we'll have a great session for the rest of it.
So great, Charles, thanks, guys. Well, thanks, Blandina. Well, today's discussion is about mature infrastructure. I was a temporary victim of glitchy infrastructure. And so, guys, thank you for introducing yourselves. The timing just couldn't be better for this conversation. We're having a record week in Bitcoin. So Bitcoin hits record highs. Money is flooding into ETFs. BlackRock's ETF is the fastest dollar ETF to hit a $10 billion valuation. So there's no question crypto assets are moving into the mainstream. In fact, for market participants, they may feel that it is mainstream. But the question for banks and fund managers is whether they have everything they need. Equity traders, bond traders, they're sport for choice. They've got they've got a highly mature ecosystem around them. And crypto has the reputation of being a Wild West, but it may be for people in the industry, that's just not the case anymore. They've got the data they need, they've got the tools they need, they've got the custody services they need, and they're all fit for tier one organizations in the new crypto era. So some will say, yep, that's true. Others will be scratching their heads thinking, absolutely no way. But perhaps we could just outline what it is we're talking about. I mean, Sean, when we talk about the data services provided for the crypto world, I mean, a lot of people are used to the simple ones, such as price and volume, maybe wallet creation. But beyond that, people are probably totally in the dark. So, Sean, what are we talking about when we talk about data for the crypto world?
Yeah, absolutely, Charles. So when we say comprehensive data at Amber Data, what we're referring to is having full telemetry into centralized exchanges, derivative exchanges, options venues, from an order book event level to trades, to aggregations, to reference rates, benchmarks, indices, and into things like open interest, volume, skews, gamma profiles, et cetera. And then from an on-chain perspective, it's really two types of data. It's accounting data, who held what, when, at what price, and then the fundamentals for the blockchain networks and the respective protocols to understand liquidity, price action, price discovery, and the mechanisms and the outcomes of those mechanisms to inform people's decisions.
And just give us a clue about the maturity of all this, because the crypto world to outsiders feels like, I did use the term Wild West, maybe that's a slightly old-fashioned term now, but from your perspective, how ongoing is this? Do you keep adding metrics? Do you get requests from financial institutions?
Yeah, we serve the largest TradFi players as well as digital assets players in the industry. And to give you some order of scale and order of magnitude, we process, this is prior to the ETF launches, but we process over $240 billion a day in notional transaction volume. And you just talked about the ETFs. With the launch of the 10 ETFs less than 2 months ago, as of today, as of about 15 minutes ago, there's $57.5 billion in AUM across 10 ETFs, which translates to about 798 1,000 Bitcoin, or 4% of Bitcoin, is held in ETFs. Now, this is the fastest accumulation of AUM for any ETF in history. So there's clearly institutional demand. That's specifically for Bitcoin, but you're going to see the same story play out with Ethereum, and then with the rewiring of the entire financial system, building around digital assets. And everybody on the call here has a key integral position in helping the institutional adoption and rollout of the new financial fabric.
Fantastic. Now, Deborah, you are the institution that people are trying to impress, a perfect example of. What data do your fund managers and analysts need? And from your perspective, are they getting everything they want?
Thanks, Charles. I think even if I think about sort of the origins of this journey, and something that you mentioned before about the operative word being Wild West here, is something I'm going to bring into my response for this. But we can appreciate that there is so much benefit in the future of digital assets being on chain, and their ability to deliver value to our customers at speed, instantaneous settlements, transparency, and inclusive outcomes for these customers. So I think it's undeniable the ability to do business with this technology is extremely valuable, and that's very evident in the BlackRock ETF data that you're mentioning before. As a bank, our role is to ensure that we are delivering our value to our customers in the safest possible way. So when we think about the use of language like the Wild West, we are very sort of cautious in making sure that, as entering into this market, that we are delivering the best, most trusted, safest solutions for our customers, and data plays a huge role in that. So the operative word for me here is trust, and the role that data can play in sort of building that trust for our customers and for our business. I think if I look at blockchain, if I look at what's happening in the industry, this is really the biggest thing to happen in financial services since internet banking. So we're looking at brand new technology and brand new products. And I think it's a really good example to look back on, because this is sort of the same way that we're looking at data. And if I think about the role of data, and it's great having Sean and James on the call because they're going to have very different perspectives on this data. But I would look at it like when you're sort of coming to a bank and you're discussing the data solutions that you're providing, we're really looking at it from sort of three ways, and then we can get into the nitty-gritty of those as well. But we're looking at it from the technology. So how can data help us to understand and evaluate the technology that we're using? It's about the utility of the token. So what sort of makes up that token? What's the provenance of that token? How can we trust that token and offer that to our customers? And then lastly, it's the ecosystem. So who are actually the players within the ecosystem that we are doing business with and our customers are doing business with? So when we look at sort of categorization of data, ultimately we're looking at it from those sort of three angles. And that's how we sort of evaluate how can we use this data for us to understand the product that we're actually offering our customers, and making sure that we as a regulated entity and as a bank are continuing to produce the most trusted, most secure product to our customers.
That's a great oversight. Thanks so much. Yeah.
I jump in, Charles, and also talk about the Wild West. I think Wild West is, I guess, a little bit of a lazy term that's still used in some of the journals that we read. But really, it has its origin because, to begin with, this asset class emerged and didn't have any regulatory structure to underpin it, right? And this regulatory structure is now emerging. We've finally got the US ETF for Bitcoin, which is absolutely something that the participants have worked long and hard for many years to lobby. I think Van Eck first put, Gemini in fact, first put in the application for their ETF back in 2016, right? So this has been a long time in the making, but one mustn't conflate volatility with Wild Westness, if you want to call it that. Yes, we have very volatile markets because the asset class is emerging. But then, as we discovered over COVID, traditional assets are super volatile too, and they can go from, they can go down 90% in a matter of weeks as well. And so, yeah, I think people that have been in this space for a long time, like we have, and Sean has, Deb has, beginning to rail a little bit against the term Wild West. So I think that's just a little anecdote I'd throw out there. Just on the ETF side, because I think it's interesting. You talked about how quickly, both of you talked about how quickly the assets were garnered in the Bitcoin ETFs. 56 billion in what, 3 months is just an incredible number. Back when I was modeling how the ecosystem might evolve, I was using gold as an analog. And the gold ETFs came out in 2004. I think it was the Spider Gold Trust that came out. And it took 3 years to garner what the Bitcoin funds did in about 3 weeks. And that's testament to, one, Bitcoin beginning to eat some of gold's market share. And there's a reason for that. We can get into that if you like, Charles. But also because I think the market is very ready for this asset. And so, it's an interesting one.
It is an interesting one. I love the gold analogy because I'm just hunting down the fundamentals here. When people trade, when people invest in crypto assets, what is it they think they're investing in? And I suspect there's a pretty big division. There are sort of believers who think that, yeah, there's going to be some utility, some use down the line. You're going to be buying things. Others will see it purely speculatively. They want to ride short term. And there are others who see cryptos just as a pseudo gold, a store of value. I mean, a barbarous relic, but a new version. James, what do you think when people are buying crypto ETFs? What is it they're investing in, and how does that reflect upon the on the metrics they're looking for? There must be some very short day traders require something very different to people holding long term.
Oh, absolutely. If you look at the ETF participants themselves, you'll have the investors that are making a bet that effectively Bitcoin will be a meaningful store of value. It's already meaningful. It's over $1 trillion market cap. So we're certainly in that space. But if you look at all of the people that are involved, you have HFT firms that are nickel and diming, right? You've got the day traders that are attracted by the volatility. And so the thing about assets is that the more use cases you have for them, and Bitcoin certainly has a lot of use cases, the more different reasons you have to want the asset or to hate the asset. That if you don't like Bitcoin, you can short it as well. And it absolutely is something that anyone can get involved with. And now that you've got the green light in the States and you've got all of the financial institutions providing the infrastructure behind it, it's a safer place. Now we can talk about the long tail of other digital asset tokens, and I'm sure Sean will. So I'll pass the baton at this point.
Yeah,
sure.
Thanks, James. I think the point that I want to call out is, why are digital assets, blockchain, crypto, what have you, so compelling? And the reason that they're so compelling, one, is it's the implicit trust in the network and the radical transparency that is not really available in traditional financial markets. In traditional financial markets, you're trading in somebody else's database. Might be in their cloud service, but with digital assets, you're on a global, shared, transparent, radically transparent network where you can understand your participation, others' participation. And as such, we now have the ability to generate and derive fundamentals that, traditional stocks seem just archaic now, where you're doing quarterly reports and annual reports when you're getting highly interpreted data, where with digital assets, I think Fidelity has done a really amazing job generating their Fidelity Digital Assets Signal Report that they publish quarterly, where they've taken and created a set of short-term, mid-term, and long-term metrics and indicators for the valuation and relative valuation of Bitcoin, for example. They also do it for Ethereum. And that goes from simple, hey, it's the 50-20, simple moving average, to things like Pi cycle to identify tops of markets, or realized capitalization versus market capitalization to understand, is the network in aggregate in profit? Is everybody making money because prices accelerated so much? Or MVRV, which is market value to realized value, to help gauge what is the is to gauge and quantify what is the fair value of the current assets, to, as James mentioned earlier, valuation like a commodity with like stock to flow models, where you're trying to understand what are the fundamentals of the production of the asset versus the supply and the impact on price and the impact of $57 billion coming into the market. Guess what? The price is going up, right? And then lastly, there's additional indicators like sentiment, NUPL, or you can even understand and quantify who are the participants by looking at the number of active addresses or the HODL waves, who held Bitcoin for how long. You can take those same telemetry and apply that to every digital asset. Bitcoin's obviously the hugest player in the room, but you can really go down the long tail to understand what are the fundamentals. Amber Data just recently published a research report. I'm going to put a link in the chat, and you can actually read about all these metrics, which we have available on our platform and our APIs and in our analytics platform.
Yeah, so Sean, let me give you a really cool stat that demonstrates both things that you're saying there. 70% of Bitcoin did not change hands in the last bear market, which means that despite the price falling 80-odd%, 70% of Bitcoin holders did not sell a single bit of their Bitcoin, right? That's amazing, because obviously as prices go through all-time high, right, they're probably not going to sell. So you're going to have this scarcity that's driven, and we can get into scarcity with the upcoming Bitcoin halving as well. But the second mind-blowing point about that is that you've got the data that you can prove that information with, and that does not exist in traditional assets. So you talk about the Wild West. Well, it's the most illuminated and enlightened Wild West that you've probably ever seen.
Sean, you're nodding with agreement there.
Violent agreement.
Deborah, perhaps you could just bring in some of your perspective, because I just wonder what your clients think. I mean, what do you advise them? I mean, you obviously can't share particular advice, but I mean, what is the approach of NAB when it comes to cryptos as a store of value, as a long-term investment? I mean, great fun for short-term punt, but what is the approach of NAB?
Yeah, thanks, Charles. Again, sort of to reiterate what I was saying before, it's undeniable the value of the blockchain technology itself, as sort of James was discussing that instant nature of it, and Sean was discussing, like, this has been around for quite some time. It's the assets itself that sit on it that sort of become a really exciting opportunity as well for financial institutions. So if we think about the assets that will be sitting on chain, it's existing assets that you're seeing now, but it's also the future assets and the possibilities of what can be sitting on chain too. So I sort of think about ESG, but I don't want to add too much on that at this stage. But as a financial organization, we really have understood that it's the ability to deliver that instantaneous service to our customers, and we're talking about trades. Probably worthwhile saying as well that NAB does work with Amber Data at the moment, and Amber Data is part of our NAB Ventures portfolio. So we've looked at it like that, business partners to partner with to help us understand this landscape and also look towards the future. What are those future opportunities? We do recognize this is an opportunity to drive real growth. We recognize that it's a way that we can deliver really exciting, fast-to-market products to our customers. We do have a duty to do the right thing by our customers in providing the safest possible service for them, and we're using data to do exactly that. Over the last year, we've launched a stable coin. We've run sort of tests and innovation programs when it comes to actually ESG credentials online associated with like green loans. So we are actively participating and have actively participated in the digital assets market. And, we continue to encourage organizations to come and work with us and to reach out with us to see what we can do going forward. I think even to relate back to the article that's been the stoker for today and the fact that, this ETF has had such a big impact, I think for me, I also work in sort of the RegTech market here in Australia through the RegTech Association. Something that gets me really excited is the fact that you have that SEC approval. And this is something that the market's really been striving for, I don't know, better part of a decade. I'm sure Sean and James would mirror that sentiment. So the fact that what this is showing to me is that there's real trust being built around this market. And I think we can start to drop the Wild West notion as we start to see players like BlackRock and Fidelity play in this. Like, these are huge asset management companies, and the SEC is, approving these products, and it's really showcasing that there's trust in the product, there's trust in the technology, and the response from the market mirrors that sentiment. The fact that you had, $6-7 billion worth of trade in the first day, and you have what currently, I think the article says $7 billion of inflows. Those are huge metrics to show that the technology is there, it's working. The product is really appetizing to the customers, and the SEC is on board on this journey as well.
That's great. And James, just for viewers who have heard Deborah talk about the level of trust. Now, when it comes to equities, bonds, other assets, we know tier one banks have really mature infrastructure. From the custody side and the surrounding ecosystem there, can you just tell us, when people invest in cryptocurrencies and other digital assets, should they expect the tier one bank experience?
Increasingly, I think we can get to the tier one bank experience. I think there are some additional risks to holding digital assets that you don't have when you're holding, say, an equity. Ultimately, if you're holding some stock in a company, your name sits in the registry, and even if you somehow forget your login to your broker, or you even forget who your broker is, you can in the end track down your ownership of your equity. And I think the big difference with digital assets is that ultimately the asset is contained in a distributed ledger, and your access to your part of the ledger is determined by effectively an extremely long PIN pass. Now, unlike your actual PIN pass, your card, in which you actually need your card to enter the PIN with, if someone knows your PIN pass when it comes to digital assets, that's all they need. They don't need your card, right? So knowledge of that, what we call the private key, is of and the fact that you should keep it secret is of paramount importance. So a digital asset custodian will do that for you. Now, there are two types of digital asset custodians or custodial services. You've got the folks that provide technology solutions. So you're effectively enabling your customers to self-custody. You're taking on some of these risks head on, albeit in a safer way with some strong safeguards. But you're not dealing with a regulated counterpart, nor do they have to be fair to them, because they are a technology provider. But then there's a second category, which is fully delegated custodians, of which we are one. So effectively, title transfer moves to us. We store the keys for you. And our philosophy is that institutions should be able to engage in digital assets in exactly the same way as they engage with traditional ones. And so what that means is that you need a regulation first global profile that they can trust. You need bank grade compliance and governance frameworks and KYC AML processes, even on chain. And that's the beautiful thing about on chain stuff. It's, people want to move assets around and use them for strange reasons. Then it's the most transparent way to get caught, frankly. And so obviously, people like us, we use services like Chainalysis, Elliptic, or TRM Labs to track assets moving across the chain, and we can stop assets coming from or going to entities that might be sanctioned. So it's a huge element of control that one gets with digital assets. Our own value proposition is that we securely keep these keys in what we call cold storage, and accessibility into that is actually near instant, which puts us apart from the other digital asset custodians. So when it comes to bank grade experience, yes, it is becoming so. And one of the things that you would expect from your tier one broker, say Goldman Sachs, is that if you have an account with Goldman Sachs and you're an institution, you can access bonds, equities, borrowing, lending, derivatives, margin financing, all those kind of great things. And I think that increasingly custodians like ours are offering all the connectivity for our institutions to all the venues that they want to trade, but also all of the functionality that is permitted by this new paradigm. So things, decentralized finance type opportunities like staking, borrowing and lending and that kind of thing.
That's hugely reassuring. Sean, I'd love to just get back to the data, because although there are parallels between traditional finance and crypto, they do function in a different way. I mean, I'd like to know how difficult it is for Amber Data to collect and distribute all of this data, because I'm just thinking of the proliferation of exchanges. There are layer 2 transactions taking place. The crypto world is inherently more complicated than traditional finance. I mean, the London Stock Exchange, there is one price for a share transaction. It is the London Stock Exchange that transmits that information. So, Sean, how difficult is it to do what Amber Data does?
It's actually incredibly difficult to do, and very expensive. And don't try this at home. To do this in a highly scalable, available, high quality way where people can build financial products and run the financial ecosystem on top of you. You just can't make a mistake. So we have to connect into, hundreds of venues to ingest real-time data, have monitoring in place, keep up with, breaking API changes, make sure that the data is high quality, high integrity. And then from the on-chain data, it's radically different than traditional financial services, because a blockchain network has effectively a distributed database with a shared state, plus an application server that's processing the smart contract. You have to be able to understand what's happening inside those mechanisms, parse that, understand that, turn that into meaningful insights, and then make that a time series. And then you need to be able to take and aggregate into meaningful insights across both the liquidity of centralized venues and decentralized venues in a unified way. So people who come from TradFi, it just works and it looks the way that they used to see it. It's incredibly difficult to do. And we've been doing this for 7 years. So the beauty is a lot of this data is even though the state is captured on a blockchain, but much of it, there's still a lot of ephemeral data that if you don't have it, you simply can't get it. So it's really, really valuable to understand, for our customers to be able to build, front office trading, research, portfolio management, risk applications, fund admins, auditors, regulators. We have quite a few regulators as customers. They're on the other side of that. They want to make sure it's transparent, it's fair. I think that there's been tremendous leaps and bounds around the world from the regulators to lean in and get the data that they need. And really, there's very few providers that can provide that comprehensive view across the whole spectrum.
And I can attest.
If I can add, oh, you go ahead, Jane.
No, go ahead.
I was just going to say, I think it's really valuable, and I think that if we look at the grand scheme of data from financial services, is our relationship with our customer doesn't start and end with blockchain or information that's on blockchain. So I think it is extremely valuable, as Sean was explaining what Amber Data does. It's the cohesion of offline data and online data, bringing that together and allowing businesses to add policy or logic to that information. So I think blockchain is really amazing about the transparency of the information on there. However, there is a level of sort of effort and challenge that comes with the marriage of that data with offline data. And that can be, as Sean was explaining, from the sources that Amber Data uses. And that can also be, at a financial institution. As an example, when you look at KYC of your customer and their participation of any business on chain, you would also wed that information up with information that sits off chain. So it's definitely a marriage of the two and cooperations of the two data that present a really strong services.
Nice.
James.
I just love. Go ahead, James. I'm sorry.
No, I was just going to jump in and attest to how hard the job that Amber Data is doing is. And I'll start with I'll just explain a really simple thing. It's like when people say, "What's the price of Bitcoin?" And just that is actually far more complex than most people think, because Bitcoin, unlike say Vodafone, which only trades on the LSE, trades on 300 different venues. right? And each of those venues have their own market makers and traders and their own different price. And so you then need to somehow, so when we try to provide a price to our customers, we'll use a service like Amber Data, and we'll present our customers with a book value for their Bitcoin, right? And that has to take in all these vagaries of all of the exchanges that it trades on. So you're effectively aggregating data from all of these exchanges for one asset, right? And then doing that across 1,000 assets. So from a data ingestion perspective, it's incredibly hard, but it's so vital for us because we can't just stream the Coinbase price because Coinbase goes down, right? We have to have a stable price that we can use the entire time that is reflective of the markets, that our clients can say, yes, that is a global price of Bitcoin in US dollars or whatever currency you want to attach it to, that then they can pin their hat on and make economic calculations with.
Yeah. Dawn, I'm also keen just to flesh out as the furthest reaches of the data you provide, because I'm thinking, you know, if I'm interested in the crypto world, I might be interested in not just the mainstream stuff like Bitcoin and Solana, but there are all sorts of arcane and wonderful things such as DAOs and DeFi lending exchanges, stuff like that. Is it possible to get data on stuff like that?
Yeah, absolutely. I mean, we really span the entire spectrum from, you know, derivatives data to understand, you know, what are dealer net positions in gamma profiles in, you know, centrally traded options, all the way down to DeFi data into, you know, say Uniswap. Uniswap did the same trading volume as Coinbase last year, which is pretty profound. We can tell you every liquidity provider that participated, what's their position size, what's their P&L, what's the price, what should have been the price, what was the price impact. And then the same thing goes for every lending protocol that are, you know, that have, you know, billions of dollars of lending that's happening with rates being earned by participants. And we can tell you who has been liquidated, who needs to be liquidated. Liquidation in DeFi is a mechanism to clean up risk, and it programmatically happens. It's pretty elegant. Well, we can tell you every participant and how everything works and the underlying mechanism. So, for example, stablecoins. Stablecoins also represent trillions of dollars of you know, basically tokenized dollars or other currencies on chain, which are the underlying asset in many of the base pairs of decentralized exchanges or lending protocols. So the stablecoins are often minted or burned in order to maintain the circulating supply. And we can tell you every time there's a mint or a burn in the stablecoin, or when there's a swap, or how much stablecoins in one pool versus another, and what are the implications across the entire ecosystem, across centralized and decentralized, as well as derivatives on that. So it's radical, the transparency that we have and we provide our customers. It's a huge edge.
Sean, I'm sure you get asked questions like this all the time because people want to have the crystal ball and be able to forecast the market movement. But you personally, what metrics do you look for when thinking about the sort of just the organic growth of interest in cryptos? I mean, I enjoy looking at wallet creation because it just shows a kind of, or developer commits, because it just shows a kind of ongoing, on the ground commitment to a currency, as opposed to, you know, the current rise in Bitcoin's been down to regulatory issues. You could be trading, reading a newspaper, or hanging out with friends who know regulators, but insider trading. But what metrics do you look for when you're trying to gauge the long-term success of a crypto asset?
So I think it depends on so I look at a lot of things. We live in data, right, with 16 petabytes of data. So, you know, we geek out all day long and look at this stuff. So, you know, it depends. If you look at like Bitcoin, hey, I really am a big fan of what Fidelity has published in their digital asset signals report, and that's why we built all those same metrics. I think they're indicative of, they're transparent, they give you a good understanding, and they allow you to back test and model what the price of the asset is. If you're looking at like a stable coin, I want to know velocity and I want to know the volume of flows, because say normally there's, you know, X number of transactions a minute in stable coins and the average value is Y, right? Well, if the number of transactions double and the transaction size 10x's, something's happening. People are moving money as fast as they can, and they're paying a premium in gas fees to get their blocks confirmed. That's hugely indicative of activity, speculation, risk, running for the doors, whatever it is. So that's a really, really key indicator. And just like anybody who does quantitative trading, momentum is actually very indicative of activity, the meaningful activity, not just noise, right? So I think that's important. And then if you get into specifically into the mechanisms of how some of these protocols work, there's protocols like Aave. Aave is effectively a real-time repo market, and there's a tremendous amount of arbitrage in digital assets between all these various centralized trading venues as well as decentralized trading venues. And the way to get leverage is often using a protocol like Aave to do a flash loan to get an instantaneous access to leverage, like a repo market, so you can do a trade and you don't actually have to pay any fee unless it gets filled. So understanding what are the mechanisms for leverage, or where there's derivatives in play, maybe even on a centralized exchange, which may cause short squeezes because a huge pile of gamma out of the money, and as the market comes into it, the market makers have to make themselves whole, and that directly gets propagated back on chain because these things are constantly balancing themselves out. So there's a bunch of areas. It really depends on your time horizon, your thesis, your use case, and your interest. I'm a derivatives guy, so I go derivatives first, and then I, go on chain. But it's pretty interesting.
Yeah, Deborah, I've constantly got in back of my mind, how people can make money out of this, where the edge is, and the emerging theory seems to be it's about mastering data from multiple sources to try and create an overall picture of what's going on from the institution, from the investor perspective, from the bank perspective. Is that about right? That there's no sort of silver bullet to trading in crypto or digital assets. It really requires gaining such an overall view of the market, multiple currencies, multiple different activities, decentralized exchanges, in order to understand what's going on.
Yeah, that's right. Like it's such a big set of data here, and that's why I sort of categorized it at the beginning with technology, utility of the token, and ecosystem. And you can hear when Sean talks about data with Amber data, we're looking at pre-trade servicing and post-trade data, and that sort of sits under these sort of primary umbrellas. So it really just showcases the sort of immensity of the opportunity and the challenge when it comes to data. So I think I would implore those who are working in data companies and wanting to enter these markets to sort of understand how we look at these things, that it's not just the trade perspective, which in itself is such a huge data undertaking. It's looking at the performance of the technology and the redundancy of the protocol that we're working with. It's what sits behind the token. As I was talking about before, like there are tokens being used now for current products on the market, but exciting features for the tokens that go ahead, and how do we track what that token represents, and making sure that that token actually does represent that. And then the ecosystem itself. So, what's happening in the ecosystem, what's happening with trades, what's happening with participants in that ecosystem. So I would think about data sort of big like that. And where we see a tremendous amount of value is being able to aggregate that data. And I think, as sort of Sean has discussed, data with Amber data, also something that we looked at most recently with Zodia actually on the call, is we ran a proof of concept looking at risk and compliance of the Zodia platform versus what banking requirements mean. Huge sort of data understanding there. And what we were particularly interested in there was the risk element of data, and the risk element of matching data that's on chain. So what's happening with customers and transactions on chain, but also what's happening off chain. So when you look at how you associate risk with different transactions, or politically exposed people or sanctions, how you can actually bring together that sort of chain information and off-chain information. So I guess we're really looking at organizations that can bring together lots of data, make sense of it, but also align it with what we're trying to achieve here, which is remove the Wild West language, replace it with trust, and making sure we, activate the benefit of the technology, which I think we're all in agreement here, but making sure that how we're doing it as a bank is that we're producing very trusted product, that we know it's trusted because we have the data and we can understand everything that's sort of going on with that product.
James, I think we've got about 5 minutes left. That feels to me like the message here, that the more data one has and the more complete picture one has of the crypto market, trust grows because you understand the mechanics and the fundamentals, and it feels less like a sort of vortex of uncertainty, just coin flipping champions. That there is a genuine underlying fundamental logic to the success of some crypto assets, some superseding others, some with greater technical grounding, such as Solana and Cardano ADA. Is that right? I mean, the more one understands the data and the mechanics of the crypto market, the more a logic does emerge, and there really are genuine fundamentals for investors.
Absolutely. I think you have an absolute richness of data and digital assets, and it allows you to make economic decisions, risk-based decisions. And of course, you can still make mistakes based on those risk or economic frameworks, but it allows you to have something that you can pin your hat on. So for instance, you might not be able to pick winners in the digital asset space. And in fact, I don't know many who can. And so you might take a simple approach of buying an index of assets, right? So, firms like Sean's make it easier to create indices, basket indices of digital assets, and then effectively buy or sell a basket. And that's a simple trend following model. In fact, as coins grow in market cap, they get added to an index. So obviously there's the momentum going there, and when they start fading, then other coins come to replace them, right? So you can make easy economic decisions like that, I think. And so, but too much data can also hang you. So I think you need to be very specific in what you're trying to achieve in digital assets. If you want to use it for risk calculations, then use the data and frameworks relative to that. If you want to have a capital appreciation strategy, there are ways that you can do that. By buying assets and then setting up hedging agreements and contracts against them, and you can do that too. And so all options are open. It goes back to what we were saying at the beginning of the conversation, is that because you have all of these different use cases for these assets and different ways of looking at them, you'll get more people interested in doing them because there's something there for everyone.
That's great. And Sean, just to conclude. Yeah, go ahead.
Yeah. So to add to that, like a really, really critical piece in the infrastructure for institutional adoption of digital assets is this custody, because I don't want to have a pile of ledger devices in a safe. That just doesn't work, right? So you really need players like Zodia Custody, like Zodia Markets that are been backed, by leading banks and what have you to really solve that trust problem. Because if you look at the total world of financial assets, there's hundreds of trillions of dollars of real world assets that people like BlackRock, Apollo, Cargill want to securitize, tokenize, and break those apart to bring those to market as packaged up financial products. Payments is a massive business for banking, but it's inefficient today, and it's slow, and it takes days to settle. And thought leaders like NAB, who are working around around stablecoins and embracing and being thought leaders and driving that technology, are changing the financial fabric to enable this. Again, you're going to need custody to hold all these things, right? And then you listen to people like Larry Fink from BlackRock, and literally on CNBC saying everything is going to be tokenized. So if you think about where we're going, this is a total transformation of financial services, the underlying infrastructure. This is a 20-year journey, and we're on the very early innings of it, but it's all data-driven and more transparent than anything that exists today, and who you need to trust and why they're providing that service, and the new value that's being created by everybody who's investing in this space is going to transform the world as we know it, just like the internet did 20 years ago. So I'm just excited to be around the table with people like James and Deborah here that are helping drive this.
Well, Sean, Sean, I'd just like to ask, if people wish to explore the crypto universe using Amber Data's rich data sources, how do they do it? I mean, you partner with a sort of a who's who of the financial world. Do they have to rely on their bank or their fund manager partnering with you, or do they go direct to Amber Data as well?
They can go to amberdata.com, sign up. We have tremendous amounts of really deep research people can read that's free. We have some exciting announcements coming up next Monday to make the data more available and more easy to access for institutions and anybody. So we're really helping and very interested in educating everybody. So just come to the website, sign up. If you want to subscribe to our data and services, you can do that online, and we'll have somebody contact you. Or follow us on Twitter or LinkedIn. We're every day publishing and trying to educate the market and have meaningful conversations and help educate and help transform the industry.
Well, Sean, thank you so much. And James and Deborah, it's been hugely educational for me. And yeah, personally, I've loved going through some of Amber Data's quarterly reports, some of the indices, or I think the link for Amber Data's Bitcoin metrics are there. It's pretty addictive. Once you start digging below the surface, the picture really does start to clarify. And the more you explore, the more the fundamentals of the entire market begin to emerge. So I just highly recommend it to anyone interested in the market. So Sean, James, Deborah, thank you so much for joining us at FinTech Talk. That was one of the best sessions I think we've had. Thank you so much.
Thanks for having me.
Thank you. Bye.
Thank you.
Thanks, Deborah. Bye.